Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel and all the comments and the subscribers. I greatly appreciate it. Okay, today we're going to look at Pepsi. They recently made news. They had good earnings with COVID, everyone's staying home and snacking. All right, let's take a look at the stock, right? This channel is dedicated to the intrinsic value. We look at hard cash flow. We don't really care about hype or good press releases or fancy graphics. We care about cash money. And we use that cash money to figure out what we think the intrinsic value of the stock is and where we look at it is, and where it's traded currently, and figure out if there's a difference and whether the difference means that we should be buying the stock. We're going to take a look at 8 years of financial history of Pepsi. Behind me is their most recent 10K. Their fiscal year is the end of December, so there's now almost 6 months of financials out there that aren't in these numbers. So definitely read the 10 Qs, get updated. But we're going to look at a long-term view of this stock, so we use the annual reports. This is their 10K behind me, as I said. We're going to go through it. I want to dive and look at the cash flow statement with you guys specifically. I'm trying to focus on that. I get a lot of questions on cash flow. I think it's the main driver of any business. So I really want to focus on it. We're going to go through my sheet as normal, but then I'm going to dive in and walk through the cash flow because I think there's something pretty interesting in Pepsi I want to show you. All right, let's take a look at the numbers. Revenue, $66.5 billion in 2011, down to up to $67 billion over that 8-year time frame. That is a 0% growth rate, right? What's inflation? 1%. So they're actually losing revenue in real terms over the decade. Let's look at EBITDA. As a reminder, I stopped giving the buildup from EBIT to depreciation to EBITDA, just pulling EBITDA directly just to speed things along. EBITDA is our proxy for earnings, and earnings are flat. 12.9 billion to 12.6 billion, slightly down. So earnings are matching, the zero growth of earnings is matching the zero growth of revenue. This is ironically exactly what we saw with Coca-Cola, by the way. I don't know if they've become too big or they're not venturing enough into the sparkling divisions, or not going into alcohol, or they're not going into cannabis drinks. But I think wherever they are, they need to figure out how they're going to grow again. But this revenue and EBITDA is capped. Let's look at enterprise value and debt and figure out what the multiple of Pepsi is and whether we think it's a good deal. And then we'll look at cash flow. All right, so we're going to look at debt here. Debt is $23 billion, has gone to $33 billion. So debt has increased by $10 billion, roughly a third. Right, that's 50% increase, not a third, 50%. Math is challenging. Over that 8-year period of time on earnings flat and revenue flat, that's concerning, to say the least. They do have some excess cash. It's kind of come down. They may have taken some of this from marketable securities line and put it into the actual cash line. Remember, I just pull what's labeled as marketable securities on the balance sheet. So if they have an overly high balance of just pure cash, that's probably why you see the drop. It could be some acquisitions they made too. Market cap is share price times shares outstanding. It's gone from 100 to 190 billion over the time period. Enterprise value 124 billion to 224 billion, up 100 billion. Mostly on the back of this market cap going up $90 billion. So market cap's moving, debt's moving, earnings are flat, revenue's flat. Let's take a look at debt first, then we'll look at the EBITDA multiple. So this is debt divided by EBITDA. I am not netting for cash, so I could have been more diligent and actually taken this 2.6 billion less the debt, then divided by, but I'm lazy, it's a template, it's just rolling. So forgive me. But what it does show is it does show a fairly rich debt level for us, right? We look for less than 3 times. They're sitting at 3x right there, and they've been bringing it down. Kudos for them. But it's in the upper range, and for a company that has flat revenue, flat earnings, why have so much debt? What are they doing? That's a problem. Let's move over to EBITDA multiple. This is how we price a security. It's a multiple of cash flow. I don't care at all what the dollar price is on the trading floor for Pepsi. I care how relative that price is to its value or cash flow. That's why we look at a multiple. So you can see it was as cheap as 9.6, which is a good price for a company that's flat, basically. And it's moved up to 18 times right now, 17.7, based on trailing 12 EBITDA and current market price. For a company that's flat revenue, flat EBITDA, and is fully debt loaded, what are we doing? Is it just the release? Is people getting chips and soda, but revenue's not growing? I'm missing the connection here. I'm not seeing it. But it's fully valued at 17 times. Let's take a look at cash and see maybe there's something in cash flow that we're missing. Cash flow from operations. Again, I'll go to the cash flow statement. Little recap. You've got the P&L, the profit and loss, the income statement. You've got the balance sheet, right? The bridge, the link between these two statements is the cash flow. It makes all cash transactions on the P&L appear on the cash flow, and any changes in the balance sheet appear in the cash flow, and that's where the rubber meets the road. We pick up the very first kind of third of the section being cash flow from operations. And here you can see it's a 1% growth rate over that period of time. It kind of goes up and then comes back down. That's peculiar. CapEx is a healthy, that's what, 50% of the 4.6. So half their money is going back into their bottling plants and back into their infrastructure. So they don't even have a chance to invest that or to dividend it, do anything. It has to go back just to maintain the status quo. Then you got debt payments. Look at this. So here they're all positive. That reflects borrowing, and that is what we have seen, increased debt levels. They make a big payment to bring that down, and then here this payment is not nearly as large. It's almost flat. I'd consider it roughly zero, 300 million, which is popping cash flow from equity, $5 billion. The previous year when they made a debt payment, their free cash flow was essentially zero, only 500 million. So something's going on here. We'll take a look at that in a second, but I'll just finish the spreadsheet for you. So shares outstanding, free cash flow per share, it's ranging between 38 cents and $3.63. Those are big swings, and it's driven by this change in debt. So we need to see what that is about. You get a yield based on the price ranging from 34 basis points to $2.65%. So that's a big swing, and it really is driven off of this change in debt right here. They made a big payment this year. They made no payment that year. Let's go to the cash flow statement and take a look. Bingo. So the cash money statement, again, my personal favorite. So net income is always the top of the cash flow statement. We go down to a third, you get operating cash flow. Operating cash is $9.6 billion. You saw that in my last sheet, 9.6 billion. I'm blocking it. 9.6 billion. So that's what I'm pulling, just straight from that number. CapEx is the next half on the cash flow statement right there. They call it capital spending, which is unique. I normally don't see that. You normally see right below it, it says sales of property, plant, and equipment. But it's the same thing. So here, 4.2 billion is what they're pulling. What we're pulling, 4.2 billion. That's what they had to spend. Now let's get to the finance section and see what's going on. So we said that we saw a large payment one year and then nothing after that. I'm going to zoom in here and see if I can't get this all on the screen. Here we go. This is proceeds from issuance of long-term debt. So the issued debt, $4.2 billion. They made their normal payment to long-term debt, $4 billion. But then they also made another payment. They redeemed debt for $1 billion. So their payment, and you look at last year, that's $5.5 billion. Year before that, $4.4 billion. This year, $4 billion. So $5 billion. Their debt payment is $5 billion a year. It happened the last 3 years running. We go back to our schedule here. This is right, 5.5. This is wrong. It's artificially high because they borrowed. And this is wrong. This is artificially low because they borrowed. Had you normalized for those normal debt payments, their cash flow, true cash flow after debt service is a lot less than we think. It's closer to zero. And again, all I'm doing is I'm just taking their debt payments here. They are borrowing, which is fine. A company, they have room to borrow. They can borrow. All companies do it. It's fine. I'm just pointing out that cash from operations after CapEx, after debt service, doesn't leave much for the critical payment, which is the dividend here, or for us, we just call it free cash flow and take it all. But you can see here, dividend payment, cash paid the dividend, $5.3 billion, and then they bought stock for another $3 billion. That is $8 billion of cash that they put out there to buy back stock and to give the shareholders. I don't think they can naturally generate. Not saying it's wrong. I'm just saying that they're borrowing money to do it. And a lot of companies do it. I'm not begrudging them to do it. But if I look at the cash they generate, again, we'll go back to our sheet. This is their historical cash flow. Operating cash flow last couple years, call it $9.5 billion, just averaging this. CapEx on the average, call it $3 billion. That's probably a 6. 9 minus 3. 9, 6, 7, yeah, I got that right. $6 billion. Debt payment, we saw it. Debt payment is $5 billion a year if they don't borrow extra, right? So then 9 minus 5 is $1 billion of free cash flow. What's the dividend, right? The dividend they're throwing out, $5 billion, $5 billion, $5 billion, plus they're buying back stock at $3 billion, $2 billion. They're getting this by borrowing. And with no growth on EBITDA and growing debt level, there's only so long they can do that. So when you forecast that, what are you supposed to do, right? You got a company that cash flow from operations plus debt service doesn't leave enough to really float the dividend. What am I going to do? So, this is actually high. I think I'm going to make an adjustment here. I'm going to average these two because this is artificially high. So I'm just going to do this on the fly there. I mean, it's not even, I'm still giving them credit, right? Realistically, it would be this number here, 3.8 billion, excuse me, $3.38 per share is the free cash flow after they make the debt payment. I'm saying that they can continue to borrow a little bit, which they can. So I'm giving them some credit averaging these two. This $3.63 is basically with borrowing. This 40 cents essentially is them paying all the debt and not borrowing. So I average the two and say it's $2. Growth rate is 0. They're not growing. Free cash flow is flat, revenue's flat, earnings are flat. That gives me, based on a 3% yield, a $66 price target long term. Let's look at EBITDA. EBITDA, again, $12.5 billion, zero growth. I'm not going to give them credit for something they haven't been able to achieve. So then on an average multiple, right, I'm not even bringing the multiple down. This is 13 is their average multiple, 13, call it 14, right here is the average multiple. They're currently at 18 times. If they come back down to average, that enterprise value is $172 billion. Less debt plus cash, market cap, less share, divided by shares, give you a $100 price target. So we have two price targets. We've got 66 and 103. Split the dividends, call it $85 a share. It's currently at $136 a share. I just can't see it. I think people are chasing a dream, or maybe it's just having all the cash that's in the market. They're part of the S&P 500, so if you buy the index, you automatically buy this. So there's no thought process, all on cash flow. But let's run through the IRR, all right? I buy it at 136, I sell it at 85, right? That's a zero growth company. That's the cash flow. I get a minus 3% IRR. I just don't see it. Unless they make some big acquisition, which again means more debt It means share dilution. It means, something's got to give if you just go buy something. You can't base a valuation on expecting to purchase something. But I think this is something you avoid. There's far more interesting stocks out there that are hitting all their numbers and are cheap than Pepsi. What does it need to happen in order to hit the numbers? Our little distribution. Look, $136 is where it's currently. It's got 3%, minus 3%, which is accomplishment. I think it's the first negative stock we've seen in this channel. It's just not. I'd wait. So I'm gonna give this. A bad. Right? Why? Let's recap. Revenue. They have 8 years to prove that they can squeeze a little bit of growth above inflation. Can't do it. 0. It's below inflation. It's negative growth in real terms. So that's one bad mark. EBITDA is not growing. Well, free cash flow is not growing. They don't have enough free cash flow to cover debt service and dividend and share buyback that they're doing to boost their earnings because EBITDA is flat, right? In order to, I bet you their share count's decreasing. Yeah, so here, share count's decreasing. Why is it decreasing? Because they're borrowing money to buy back shares because they can't grow earnings. They have to do something, so they're buying back shares to artificially inflate earnings per share, which is fine. We've looked at companies that did this before, but they were doing it with free cash flow because it was just falling onto the table. They had nothing to do with this. They bought stock. Fine. Here they're doing it with borrowed money because they can't grow earnings. So I think that's no debt. They're close to 3x, which is not impassable. It's fine, but it's not where we want to see if they're not growing. And well priced, no. For something like this, 18 times earnings, no way. There's other stuff that is growing that's at 18, and there's things that are growing that are cheaper than 18. So I think this is a pass for us. I'm going to say it's bad. It's up there with Coca-Cola for me that, they haven't figured out how to grow. And I love Warren Buffett. I love that he owns Coca-Cola forever, but he bought it before I was even born. So his cost base is 0. He's never selling. So it's really hard for us to say that because he owns Coke, it's a good business to be in. Same thing with Pepsi. I just haven't seen them been able to grow. Maybe I'm wrong. Let me know. Open to criticism. Honestly, I'm not perfect. I'm looking at the numbers. I'm stringing. One last thing. I did want to show you a forecast I see on the street. I'm not sure how they get this, but the street's calling for a long-term EBITDA target of $22 billion. So if you go out 10 years, the street's saying that's their target. I don't know how they get there. If they had last decade roughly of 0 growth, next decade is supposed to suddenly turn around and grow earnings 6% every year for the next decade to give me $22 billion? Maybe. What does that do to the stock? If I just said 0, just forget the cash flow year and say only based on EBITDA value, that's $186 price target. Again, just forget the cash flow. Give me the valuation based 100% on the street's EBITDA target of $22 billion in 10 years. That's $186. It's currently at $133. That is a 5% return annualized. So even if they hit the forecast, which is growth, it's still mid-single digits, which basically subpar, certainly for this channel. I think you go someplace else. Thank you for watching. Thank you for subscribing. I love the comments. I'm trying to crank through as many as I can, and certainly the number of stocks and the suggestions out there are fantastic. Hit the like button. Love the subscribers. Love the comments. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. Appreciate it. Have a good day. Bye-bye.